Good afternoon, everyone. We will get started here in about 60 seconds. Just waiting for everybody to join. All right. Again, good afternoon, and thank you all so much for joining us. My name is Dylan Pierce. I'm head of advisor solutions for our firm, Newfound Research, and I am incredibly excited today to bring you, to connect you to Corey Hofstein and talk to you about the newest strategy in the Return Stacked ETF lineup. Is the Return Stacked U.S. Stocks and Futures Yield ETF. Uh, all the details, including the presentation material that we're going to review today, can be found at returnstackedetfs.com. You'll find information not only on this newest strategy, but the others in the suite, which cumulatively today are fast approaching $500 million as a suite. So again, incredibly excited to talk to you about this newest fund. We will have time for questions at the end, and feel free to submit those through the chat feature to myself. I will interject those, Corey, into your conversation, or again, those that we don't get to work into the presentation today, we will address at the end of today's call. And with that, I will turn it over to Corey Hofstein, who is Chief Investment Officer and co-founder of Newfound Research and portfolio manager of the strategy. Corey, to you.
Well, thank you very much, Dylan, and I appreciate everyone joining me. Good afternoon for those joining from Europe and the East Coast. Good morning for those from the West Coast. My name is Corey Hofstein. I'm the co-founder and CIO here at Newfound Research and one of the PMs of the Return Stacked ETF suite. If you haven't heard of the Return Stacked suite of ETFs before, ultimately what this suite aims to do is unlock the benefits of diversification by allowing you to introduce alternative investment strategies and exposures into your portfolio without having to sacrifice core stock and bond exposure. Each ETF in the suite follows the same simple formula. For every $1 invested, we provide $1 of either core stock or bond exposure, plus $1 of exposure to an alternative asset class or investment strategy. We launched our first ETF in February 2023, and the suite just passed over 450 million, rapidly on its way to 500, hopefully. And today I am incredibly excited to introduce our newest launch, which is the Return Stacked U.S. Stocks and Futures Yield ETF, RSSY, which currently has just over $120 million in assets. So what is return stacking? At its core, return stacking is layering one return on top of another. In our approach, for every dollar you invest in one of our ETFs, we provide $1 of core stock or bond exposure plus $1 of exposure to a diversifying asset class or investment strategy. Now, what I want to highlight is that this is really not a new concept. This is something that has been used by institutional investors going back to the 1980s. It just previously wasn't available to most investors in a mutual fund or ETF wrapper, and that's why we're so incredibly excited about bringing it to you today. Why do we think that this structure is so interesting? Well, we believe that ultimately the potential benefits of it are numerous. But really what it comes down to is that historically diversification has been this process of what I would call addition through subtraction, where we've had to sell things in our portfolio to make room for diversifying alternatives or asset classes, which increases not only the performance hurdle with which these alternatives need to overcome to add value, but also, in my opinion, introduces a really significant behavioral hurdle. And so first and foremost, this structure of return stacking allows investors to include diversifiers, whether those are diversifying asset classes or investment strategies, into their portfolio without having to sacrifice that core stock and bond exposure. And that should significantly reduce not only the performance hurdle rate, but also help significantly on the behavioral side of the equation. Second, return stacking provides a really novel approach for investors who are seeking to generate excess returns. So we've all seen the SPIVA reports, we've all seen the Morningstar reports that suggest how hard it is to beat the market through security selection or picking stocks. Return stacking gives us a way where we no longer have to fish in the same pond as everyone else. Instead of trying to find alpha through stock picking, we can simply keep our stock beta, keep that large cap equity exposure, and stack an alternative investment strategy on top and use that combination to try to beat the market over the long run. Finally, return stacking has the potential to improve internal portfolio diversification. If we're thoughtful about what we stack and truly try to stack alternative diversifiers on our existing stock bond allocation, it has the potential to reduce portfolio volatility and reduce portfolio risk. What we think really, again, makes return stacking so powerful is that it unlocks the one thing that people in this industry tend to agree on, which is that all else held equal, more diversification is better than less. If we can add more diversifiers to a portfolio, it not only has the potential to improve the certainty with which we achieve our outcomes, it might actually improve the outcomes themselves. So in this graphic, what we're showing is the hypothetical growth of $1 invested in an asset class that has an expected return of 8% and an annual volatility of 16%. The x-axis here represents time, number of years, and the y-axis represents the growth of that dollar. The black line captures our expected portfolio growth over time, while the cones that we see around that black line capture the potential range of outcomes. So that light blue dashed line represents the potential range of outcomes, the growth of our dollar, if we invest in only one asset. We can see that by adding a second uncorrelated asset to the portfolio, assuming it has the same expected return and same volatility, that cone shrinks. And adding a third asset shrinks it even further. Ultimately, the more diversification we're able to introduce, the greater we are able to create a financial plan with increased certainty. But the potential of diversification actually goes beyond that, because the last graph had a subtle error in it. It showed that the expected outcomes for each portfolio was the same, and that's actually not true. In reality, improved diversification can actually improve our expected outcomes as well. By reducing portfolio volatility, we decrease expected drawdowns, and with it, the potential drag that losses can have on your portfolio, allowing us to compound wealth at a faster rate over time. Yet, despite all these potential benefits, investors are usually woefully under-diversified for all the reasons we mentioned before. Performance hurdles are difficult to overcome, and behavioral hurdles make it hard to stick with alternatives. And that's precisely why we're so excited about the return stacking concept and this suite of ETFs, and why we think it's catching adoption so quickly, because ultimately we believe it helps you unlock all these benefits. So let's dive into the core of what we're here to talk about today, which is RSSY, our newest ETF in the suite, the Return Stacked U.S. Stocks and Futures Yield ETF. Again, we launched this just about 3 weeks ago, I believe, already over 120 million in assets. And the idea here of this ETF is that for every dollar you invest, we are going to provide $1 of exposure to large cap US equities and $1 of exposure to a futures yield strategy. Let's start with the US equity strategy, because that is ultimately the most vanilla and the easiest to explain. Our goal with the US equity strategy is simply to provide low cost, market cap weighted, large cap US equity exposure. In other words, there is no ambition for any active strategy here. We're just trying to give you core large cap beta in as low cost and tax efficient a manner as we can. So to actually achieve that goal, what happens is when you invest $1 in the ETF, we are going to take about 75 cents of that dollar and invest it in large cap US equities, or a low cost large cap US equity ETF. And then we take the remaining 25 cents that's left over and we invest it in US T-bills. That 25 cents in T-bills serves as collateral for 25 cents of exposure to S&P 500 E-mini futures. It also serves as collateral for the dollar of futures yield strategy exposure we'll be discussing in a minute. So when you take that together, investing $1, getting 75 cents of actual stock exposure, either directly or through an ETF, plus the 25 cents of S&P 500 E-mini exposure, we create $1 of large cap US equity exposure. Now let's get into the real sort of meat and potatoes here. Probably the thing most people are most unfamiliar with. Obviously, we believe that the stacking component of what we're doing in this ETF is a really key feature of the offering. But what we're really excited about with this ETF is introducing a multi-asset futures yield strategy to the market because we believe it's such a novel diversifier that almost nobody has access to directly. So what is futures yield? I want to start with maybe a bit of an analogy. Consider for a moment investing in a piece of property. You could, in theory, earn money two different ways. In the first way, the property could simply appreciate in value. In the second way, you could rent out the property and earn an income. That second component, that income, is really a yield and is sometimes called the carry and is the source of return that futures yield strategies try to focus on when we take it from just focusing, say, on rental property and thinking it more broadly of across stocks, bonds, currencies, and commodities. Now, people typically have a negative perception of carry strategies because they have in their mind things like the infamous yen carry trade back in 2008, or because they associate carry with these coupon clipping strategies like selling puts, which we often think of as picking up pennies in front of a steamroller and being highly correlated with equity drawdowns. Now, these sorts of trades and strategies are technically carry strategies, but they bear very little resemblance to the way we think about building a multi-asset carry strategy. What I cannot make clear enough is that we are not trying to isolate and clip coupons here. Instead, we believe that carry ultimately tells us something very, very important about the total return potential of an asset. So as a parallel, maybe think about shareholder yield within equities. Those sorts of strategies are going to look at the combined dividend yield, share buyback, and debt pay down as a company as a signal for the potential total return of the investment. Similarly, we are going to look at a variety of measures of carry in stocks, bonds, currencies, and commodities as signals for each of the futures market's potential total return. So it is the signal that is driving the strategy that's really important, and hence why we called it futures yield. Now, historically, carry or multi-asset futures yield strategies have exhibited a lot of really attractive features. Over the long run, they've exhibited positive long-term returns and had low correlation to both stocks and bonds on average. And if we look at some of the biggest periods of equity drawdowns, we also find very little correlation. Again, I think this is against the intuition most people have about carry strategies, but multi-asset carry strategies are very different than the types of carry strategies that are simply trying to clip coupons. I really want to stress that. Again, it's important to distinguish between these two. Now, given these features, right, the long-term positive expected return, as well as the low average correlation to stocks and bonds, it should probably be no surprise that these sorts of carry signals and strategies make it one of the most popular systematic macro strategies. In this graph, what we did is we went through the current managers, of which there are 20, in the SocGen CTA index. We went through all their brochures and fact sheets and websites and podcast interviews that we could find to figure out what trading styles and signals they claim to use. And we can see that of the 20, trend remained the dominant signal, but we can also see that carry is a strong second. And that should be no surprise based on what we just saw about carry's historical performance. Yet, despite carry being one of the most popular signals used in the systematic macro space, there are no other standalone multi-asset carry strategies available in the market today that we are aware of, excuse me. So how do we actually measure carry or futures yield in different asset classes? And why do we believe that these measures will provide any sort of information about the future total return of the asset class. Well, carry ultimately is the return we expect to earn, assuming price doesn't change, or really the world at large doesn't change. And so as we work through each of these asset classes, we can think, well, what would that return be? Most of you listening are probably familiar what the answer is in equities. We're effectively talking about dividend yield. If we buy the S&P 500 and none of the stocks in the index move at all, we will ultimately earn the dividends over time. At the country level, which is typically what we're talking about when we look at yield, dividend yield, and carry in the futures market, we believe that this measure is ultimately a proxy for fundamental risk, particularly if you take that measure and compare it against historical averages. So you can think sort of naively, for example, well, if I were to look at the dividend yield of the S&P 500 over time, you would see it spike in periods like 2008 where there's increased economic stress and ultimately a sign of higher fundamental risk in the market. And so that higher carry measure is a sign that you are going to be bearing excess risk and ultimately something we think you will be rewarded for. It is a risk premium. In bonds, we have what is likely, again, going to be a very familiar measure to you, coupon yield. Or more precisely, it would be something like coupon yield plus the roll down that you could earn in holding the bonds over time with the yield curve. Again, the risk-based narrative here, I think, is fairly intuitive. We're going to demand higher yields and steeper yield curves as compensation for country credit risk, illiquidity risk, monetary policy risk, and inflation risk. Commodities, when we get there, things get a little bit less intuitive unless you've been trading commodities for a while. But I want you to consider the world from the perspective of a commodity producer. By selling futures contracts, they're effectively locking in a price at which they can deliver that commodity in the future. By locking in that price, they are able to lock in a more stable cash flow estimate, which allows them to borrow and finance their business at more competitive rates, which drives down the cost of capital. So in commodities, carry effectively measures taking the other side of this trade. In other words, you're providing liquidity and price insurance to commodity producers, which they will ultimately pay a premium for. Again, it's a form of price insurance or a risk premium. Finally, in currencies, we're effectively capturing the spread in interest rates between countries, which largely captures country credit risk and local inflation risk. But when you just say credit, it captures things like funding liquidity and consumption growth risk and a number of sort of smaller associated risks. But again, all risks that we're ultimately bearing and why we think that this measure is truly a risk premium. And this tie between carry measures and risk provides both the intuition for why we think carry would inform us about future total return of any of these assets, but also the confidence as to why we think this sort of strategy isn't easily arbitraged away. At the end of the day, unlike other strategies that are relying on the misbehavior of investors, we believe that carry is largely compensation for bearing risk. And as a risk premium-based strategy, we don't think that is easily arbitraged away, as ultimately investors will always demand some sort of form of compensation for the risk that they are bearing. Oh, jumped ahead a slide there. So the more concrete example, let's take a look at this graph, which illustrates carry as measured in the 10-year U.S. Treasury. On the x-axis, we have time, and on the y-axis, we are measuring basis points of the cumulative carry. The blue line is going to capture the spread between the 10-year U.S. Treasury and the 1-year U.S. Treasury, so the spread in yield. And that light green line measures the roll down, or how much a 10-year bond would change in price over a given year, assuming no change in the yield curve. This change in price happens, if you're not familiar with bonds, because as the 10-year becomes a 9-year, its price needs to change so that the yield on that 10-year, now 9-year, aligns with the yield of all the other 9-year bonds. That darker black line is simply the sum of the blue and the green lines. And there's a few important points I want to highlight with this graph as an illustration. First, we can see that carry changes over time. There are periods of high carry. There are periods of low carry. There are even periods of negative carry. Carry strategies will ultimately sit patiently and try to collect that risk premia, whether we're long or short, and try to adapt and seek out higher yields across different asset classes and markets as financial and economic conditions change over time. But we can also see that carry is fairly stable locally in time. In other words, we don't generally expect carry to suddenly change in a day or a week or even a month, but it is something that can change meaningfully over a year if economic regimes change meaningfully. Finally, I want to point out different carry behavior in different years, specifically 2008 versus 2022, because one of the questions we've received a lot is, well, how do you think about carry strategies versus, say, trend following strategies? And I think these two periods highlight some pretty significant differences. So in 2008, if you put yourself back in 2008, this was a period where there was significant economic stress and central banks started cutting key interest rates, and investors in the market started bidding treasury bonds as a flight to safety. And so what we saw was that interest rates declined and the yield curve flattened as investors fled to duration as a way to manage risk in their portfolio. This meant that carry went down. But at the same time, because there was such a bid to bonds, bonds rallied in price, and so trends in bonds were very positive. So you had, in that period, within bonds isolated, the signals were negatively correlated. In 2022, you had a very different situation. You had an inverted yield curve as the Fed was hiking rates. So what you had with that inverted yield curve was a very negative carry. Again, negative carry, much like 2008, but because the Fed was hiking interest rates and people were fleeing from duration, it caused prices in bonds to decline and you got negative trends. So you had a negative correlation between trend and carry in 2008, but a very positive correlation between trend and carry signals in bonds in 2022. I highlight this only to say, again, with some of the perceptions we're trying to fight around carry, a lot of people believe that carry and trend simply cancel each other out. And that is definitively not the case. They're both adapting to market regimes using different types of signals, sometimes on the same side of the trade, sometimes on opposite sides of the trade. And that's why you see carry being the second most popular systematic macro strategy after trend following, because it is such a great complement and diversifier to trend. So I also want to note, finally, with this picture, while we're focused exclusively on just an example within the 10-year U.S. Treasury here, that if we were to plot the rolling carry of other assets, we would see totally different pictures. And one that I don't have plotted, but I want you to think about in your mind for a second is equities. And again, we can consider 2008 versus 2022. In 2008, equities sold off dramatically, but at the same time, short-term interest rates went towards zero. And so if you were to look at the dividend yield of equities minus short-term rates, that carry suddenly became very, very attractive. So you had negative trends in stocks, but very positive carry. I want you to now think of 2022. The dividend yield in equities did not change all that dramatically, but the short-term interest rate went up significantly. Carry in equities suddenly went negative at a time that equity prices were also declining. So much like much like trend and carry in bonds had different correlations in 2008 versus 2022, we see the same thing in equities. But we also see that in equities in 2008, we would have had a very high carry versus 2022, a very low carry. I point all this out only to say that these are dynamic signals that are very regime dependent, and the correlation within assets is going to be very different depending upon the regime, and the correlation to different systematic macro strategies is going to be very different depending upon the regime. So let's talk about how we build a portfolio, right? We've learned what carry is. We've learned how we measure it. We've learned why we think it's a persistent feature in markets and why it's going to ultimately inform us about total return expectations. How do we take all that and combine it into a portfolio? And for us, it's a three-step process. First, we're going to measure carry in a variety of ways across all the markets that we trade. We'll get to those markets in a minute. Second, we're going to optimize portfolio weights to try to maximize the portfolio's risk-adjusted carry. Typically, this means going long the things with positive carry, short the things with negative carry, and trying to maximize the advantage of diversification opportunities both within and across assets. Finally, once that portfolio is formed, we are going to scale the portfolio weights up and down so that we target a constant annualized volatility of 10%. I think what's really important here is that because the strategy holds so many different markets in different parts of the world, responding to different systematic or idiosyncratic risks, and it can be long or short in alignment with current carry conditions, it's usually really well balanced against a variety of different types of shocks, which means it is far more resilient to most market conditions than I think people typically have a perception of when they just hear about a standard carry strategy. Sort of as an example of the strategy's dynamism, I wanted to show some hypothetical portfolio weights. So the green dots here represent June 2022, whereas the dark bars are going to represent December 2023. The first thing to notice is that the strategy can take both long and short positions across stocks, bonds, currencies, and commodities. Next, we can see that the market positions can change substantially over an 18-month period, either because the carry signals changed or because diversification opportunities changed. For example, if we look at just the leftmost 4 or 5 markets in this graph, we will see that we have all the international currencies that we trade: the Australian dollar, the British pound, Canadian dollar, euro, and the Japanese yen. And we can see that in June of 2022, the strategy would have largely been short this basket, with the exception of the Australian dollar, and therefore effectively long the US dollar. If you fast forward 18 months, the strategy would have been both long and short these international currencies, taking a more cross-sectional bet rather than a strong beta bet on the dollar. What we really want to highlight here is not the particular positioning at any point in time, but the strategy's ability to adapt and react to changing macro environments and carry opportunities as they become apparent in those environments. Now, as with our trend products, we strive to provide a really comprehensive, diversified global investment universe across stocks, bonds, currencies, and commodities, while simultaneously making sure that the underlying markets we trade are sufficiently liquid enough so that market makers can provide tight markets, and the ETF is able to operate at significant scale without us making any change to the strategy. And so we often get questions, well, why are you trading these markets and not others? For us, it's really a question of scale. The question of, can the ETF trade the same way at $5 million, as 50 million, as 500, as several billion? Because we don't want style or strategy drift. We want the track record to be implemented consistently, regardless of size. And so what we found is that this cohort of 26 markets that we're trading here provides us a really strong cross-section of diversification of the markets that we trade and the carry opportunity within them, while still being things that we can trade at scale and having significant liquidity so that market makers feel comfortable that when you are going to market to trade this ETF, they can provide fairly tight bid-ask spreads in their ability to hedge the underlying components. Now, when it comes to using RSSY in a portfolio, I think the use case is hopefully pretty straightforward via the stacking mechanism. We really believe that futures yield is a novel and unique diversifier, and that's true for any stock bond combination, whether you're the most conservative investor or the most aggressive. And stacking it on top ultimately provides not only an additional source of return, but the potential for the improvement of internal portfolio diversification. And because of RSSY's dollar for dollar design, we think that sizing is pretty intuitive as well. So On the left side, we have your very standard 60% stock, 40% bond portfolio. As we get to the middle graphic, what we have done is we have replaced 20% of the stock component with a 20% allocation to RSSY. If we then X-ray through and ask what actual exposure do we have, well, we have retained our 60% equity. We still have our 40% bonds, and we've effectively stacked 20% of that futures yield strategy on top of the portfolio. The far right represents, our much more aggressive investor who was 100% equity. We replaced 20% of that equity with 20% in RSSY. And again, when we do the X-ray, we are left with a portfolio where we retained all the beta we had before, but now are stacking an additional 20% of this futures yield strategy on top. So in grand review here, $1 invested in RSSY provides $1 of large cap US equity exposure plus $1 of exposure to a futures yield strategy. This construction ultimately allows you to retain your exposure to core stocks and bonds while simultaneously introducing a novel return stream to your portfolio for both its return and risk enhancing potential. And we believe that multi-asset futures yield is a particularly exciting strategy because it offers access to a unique source of risk premia most investors don't currently access. This means we believe it is not only a potential enhancer for returns because we believe it will have the potential to generate positive expected returns, but should exhibit low correlations on average to stocks, bonds, and other active strategies, making it a really attractive diversifier to any portfolio. So with that, Dylan, I'd love to bring you back. And again, thank you everyone for tuning in. I know the feedback we got upon launch of this strategy was a lot of excitement, but also I think a lot of questions as to, well, what is carry? What is a futures yield strategy? How does this work? How does it pair with perhaps other components of my portfolio? And that. So I hope this answered some of those questions. And I know, Dylan, we had a number of questions submitted both before this call and during this call that I'd love to take the opportunity to address.
Yeah, Corey, thank you. So let's start with some of the questions that we received in advance of this call that I don't feel like were maybe explicitly addressed. You referenced a number of times the sort of the low correlation between carry and trend. Can you just speak more specifically to what the correlations are there?
Yeah, so much like trend is a strategy that has on average low correlation to stocks and bonds, but has what we would call time varying correlations. There are times where if equity trends are positive, trend has a very positive exposure to equities, and therefore positive correlation. And similarly with bonds, we find the same relationship between carry and trend. On average, we believe that our version of futures yield or carry has an average correlation to a diversified trend index like the SocGen trend index of somewhere around 0.35. So it is actually slightly positive, but that can vary, right? As we sort of mentioned with this example, the trends of what's happening in bonds versus carry signals, the correlation of what's happening with trend signals or carry signals in different market regimes can be polar opposite, or they can be going in exactly the same direction depending on what's driving that regime. And so what we find is there are periods of significant negative correlation and there are periods of significant positive correlation. Interestingly enough, recent empirical studies we've done internally suggest that when there's negative correlation, carry actually tends to be the slight winner versus trend, maybe suggesting it's a good signal for long in the tooth when trend gets a little long in the tooth, versus when they are positively correlated or have just zero correlation, they both return about the same on average. And so I think they make a great diversifier to one another. We would expect it to be time varying, but ideally when it is, positively correlated, it's because you're getting both trend and carry tailwinds at your back, which might be some of the best times to be investing in those markets.
Great, thank you. And sticking with the carry strategy for 1 second, can you talk about, do we have any sort of return expectations for multi-asset diversified carry?
Yeah, so So this is one that I'm going to try to approach from a more fundamental argument perspective. Rather, I mean, there's always back tests, but let's be honest, we should be highly skeptical about all sorts of back tests, and it's hard to say, well, what's sort of old market regimes versus new market regimes. Again, I think what's really important with carry is I am a believer that carry is compensation for risk, that you are ultimately earning a risk premium. And I tend to believe that sort of the long-term market clearing price for risk premia is a Sharper of around 0.3. So if you have a 10 vol asset, you would expect to return about 3% a year. And that 0.3 is pretty consistent in stocks and bonds. And so if we look at this and say, optimistically, let's pretend there are four unique risk premia that we're tapping into: stocks, bonds, currencies, and commodities. And let's say they're completely uncorrelated with each other. Well, then we can use sort of the fundamental law of active management and say, okay, we get our 0.3 Sharpe ratio times the square root of the number of bets. In this case, there's four independent bets. 0.3 times the square root of 4 is equal to 0.6, and we would expect a 0.6 Sharpe. Now, 0.6 Sharpe on a 10 vol strategy gives you 600 bips a year. Subtract 100 bips of costs, and you're down to about 500 bips. And that's if they're perfectly uncorrelated. You know, you might be able to scale that down a little bit if you think they're more correlated than, you know, maybe equity risk isn't always uncorrelated to bond risk, isn't always uncorrelated to country currency risk. And so, you know, maybe that 0.4, 0.5 range. I do know Adam Butler, the CIO at Resolve Asset Management, would also, you know, say, if he were on this call, if you were to just run a risk parity strategy of these assets, you tend to historically get a Sharpe ratio in the 0.6 range. And a risk parity strategy, again, not doing exactly the same thing as carry by any means, but tapping into some of the same risk premia concepts, you know, gets you in that 0.6 range. So I think if you're more optimistic, lean 0.6. If you're more pessimistic, I think you can lean 0.4. I think somewhere in that range is quite reasonable for a long-term expected return. That said, again, much like equities, right, what we find when you talk about equity having a long-term Sharpe of 0.3, that doesn't mean every year, right? This is not an absolute return strategy. This is a total return strategy. And so much like you would think of equity returns sometimes being very high, sometimes being anemic, sometimes a negative year, you would expect the same thing in a futures yield strategy.
Right. And this next question, I know we're focused specifically on RSSY today. Many of our clients are looking at this in the context of their existing allocation to the return stack suite, and including the trend strategy. So this is totally subjective, but can you weigh in on when you might use one, the other, how you think about combining them? Like, I would love your thoughts there.
Yeah, I know this isn't your question, and I will get to your question, but I just have to say, part of one of the things that when we were building out this suite, I thought about selfishly, personally, was I always loved the idea of sort of being the vanguard of these concepts, that someone could just buy two of our funds and have this very diversified stacked portfolio. And so actually a friend of mine who's looking to invest his own personal capital saw this come out and said, man, if I put half my money in RSBT, which for every dollar gives you $1 of bonds plus $1 a trend, and half my money in RSSY, which gives you $1 of stocks plus $1 a trend, he's like, I get this wonderfully diversified portfolio with just two funds, 50% stocks, 50% bonds, and then I stack 50% trend and 50% carry. And I think that's, you know, again, a super attractive two-fund portfolio. I recognize probably not feasible for most advisors to deliver two-fund portfolios to clients, but I only highlight that to point out, like, there's a tremendous amount of internal diversification available both in the traditional betas as well as the alternative strategies. As it relates to trend and carry, again, we think they're incredibly powerful diversifiers. There are periods where they will disagree and periods where they agree, and we think those periods where they agree are really powerful because they suggest periods where you not only have trend tailwinds, but you have carry tailwinds in these assets. And so it actually, we find it doesn't make sense to enforce any sort of, you know, correlation limits between them, that when those two signals are in alignment, it's pretty powerful. You don't necessarily know when that's going to happen, right? That's hard to time, but when it happens, it's I think a pretty powerful tailwind. I think it's hard to beat 50-50, a 50-50 trend carry split. I do think the dynamics of the returns between them are pretty different. People tend to see trend as more right skew, and I think carry returns tend to be more symmetrical. I think the perception is carry returns have a fat left tail. Again, I think that's those carry strategies that are clipping coupons and picking up pennies in front of a steamroller. A multi-asset carry strategy, the way we implement it, where carry is being used as a signal to inform future returns, I think has a much more symmetric, diversified return profile. And I think, again, it just makes a very natural complement to trend. So 50-50 makes sense to me. One of the things we have heard from clients is they actually feel a little bit more comfortable leaning into trend for some of their more conservative clients that want that maybe more mechanical convexity aspect towards equity drawdowns. But I will say, again, carry has exhibited historically some absolutely wonderful and powerful diversification to both stock and bond drawdowns that I think I'd be remiss if I said, any chance we get to improve the diversification of our portfolio, that's good for both aggressive and conservative clients alike.
Right. One more question that we received prior to the call, and then we'll get into a handful that have come up since the start of this conversation. You sort of implicitly addressed this throughout the discussion, but I'd love if you could just expand on any thoughts of when should we expect a carry strategy to struggle?
So we talked a little bit about this when we were talking about how the portfolio is comprised. And again, we are allocating long and short across stocks, bonds, currencies, and commodities. And it makes it this really well internally diversified portfolio. And part of the, I'm going to use air quotes here, part of the problem with that is that it has very little correlation or persistent correlation to stock performance, bond performance, either on average or in any sort of melt up or melt down. It seems to be very non-sensitive to any particular economic regime. If you break the world into high growth, high inflation, or high growth, low inflation, low growth, high inflation, low growth, low inflation, like this type of carry strategy seems to be largely indifferent, which is a little frustrating from the perspective of, okay, well, when is it going to perform poorly? And the answer is a little maybe theoretical, but the idea here, right, is we are getting paid for bearing risk. And so when the market misprices that risk, and there's a big exogenous shock, or maybe even an endogenous shock to the market, that is where carry will typically be offsides. So COVID was a good example where probably carry in equities should have been a lot higher going into COVID. It wasn't enough compensation. Equities sold off dramatically. The market sort of mispriced that risk across the impact to commodities and commodity producers. Like, you were just totally mispriced on a tremendous number of these risks. And so carry strategies actually suffered during COVID, and it took a while for the strategy to renormalize. And then it just sort of resumed collecting this diversified risk premium across assets. And so it's a little hard to say, well, is it going to do well or poorly during a given equity drawdown? It is historically uncorrelated to equity drawdowns. There are some equity drawdowns where it's done incredibly well. Like, historically, carry strategies actually did quite well in this sort of design of carry strategies did well during 2008, but did poorly during COVID. So it's not really correlated to equity drawdowns, bond drawdowns, commodity drawdowns. It's more about what sort of idiosyncratic shocks or even systematic shocks are going underpriced in the market, and we just really weren't collecting the right amount of carry for when that shock happened.
Great, thank you. Okay, we got a couple here that have come up throughout the discussion, and hopefully we can move through these quickly. I imagine, in reference to the analogy that you made with shareholder yield, there was a question that came up about within equities. Does the carry calculation include buybacks, or is it just focused on the dividend yield of equities?
Yeah. So when you look at the way this is captured within futures, this is a sort of academic technical answer, and I apologize if I put anyone to sleep with this answer. When you're talking about what is actually captured in the futures discount relative to spot, you basically, the price of the futures is going to trade both in alignment with the risk-free rate as well as the expected dividend. And that's because if you were to try to hedge a futures trade, you would buy the underlying stocks. And in buying the underlying stocks, you have effectively hedged any buyback risk. And so it doesn't need to be priced into the futures. So when you're using futures to try to measure this futures yield component, it is just the expected dividend yield. And I think there's also an argument you could be made that the more uncertain that dividend yield is, there's actually going to be a risk premium built in because, right, dividends are not guaranteed. There can be cuts that can happen. And so you were going to price in a bit of a risk premium for that as well. But to the core question, it is not measuring comprehensive shareholder yield. It is predominantly dividend yield.
Great. Thank you. A couple of questions here that came in that are related to one another. So we'll break these apart. But what's the expected volatility for the fund, RSSY?
Yep.
And then another related question you can tie into that is when you mentioned the target 10% volatility, is that for the fund at total, or is that specifically for just the carry strategy?
That the 10% target volatility is just for the carry strategy. So then for the fund total, we are not managing the vol of the equity sleeve, right? So equity vol could be 10, it could be 20, it could be a lot higher depending on the regime. And again, depending on the regime, the carry strategy could be positively correlated with stocks. It could be negatively correlated with stocks. So at any instantaneous time, right, the strategy vol could be a range of places. We would sort of expect it long term to probably be in that like 16 to 19% on average. But again, in the short term, it could be lower because equities vol is lower and carry is negatively correlated, or it could be higher because equity vol is higher and carry is positively correlated in that regime. It will largely depend on the regime, but I would expect on average over the long run it to be in that sort of 16 to 19 range.
Perfect. And we got two questions here that we can, I think, also tie together. Can you talk about taxes with the strategy? And will the ETF issue a K1?
The ETF will not issue a K1. Like many managed futures and trend strategies, the culprits of issuing a K1 tend to be your commodity futures exposures. And so like every managed futures fund on the street, we do the same thing where we trade those in a Cayman entity, which turns that K1, eliminates the K1, but what it does is it turns the P&L into ordinary income. Again, this is the same way every commodity fund and every managed future strategy in a ETF or mutual fund operates. From a tax perspective, let's go back because there's two components to this. So there's first is the equity component. When you give us $1, we'll take 75 cents and we will invest it in as tax efficiently managed equity exposure as we can. So we would expect that core 75 cents of beta to be very tax efficient. Ideally, you will receive the dividend at the end of the year. We are required by law to pay that out to you, but there should be no cap gains from that component, or de minimis cap gains as best as we can manage it. There will then be 25 cents of T-bills. Those T-bills will generate coupons, and that will get distributed at the end of the year as ordinary income. Those T-bills are then used as collateral for S&P futures exposure. Those S&P futures, 25 cents, have to be rolled every quarter, and you get 60-40 tax treatment, 60% long-term, 40% short-term cap gains treatment. So in a very bullish equity year, you will be realizing higher taxes than just a passive 100% equity position because you're going to get the T-bill exposure as well as that 60-40 realized gains on the roll of the futures. On the futures yield strategy itself, there's very little we can do to be tax efficient when it comes to futures. In other words, there's nothing about the ETF wrapper that we can take advantage of to try to make it more tax efficient. So the commodities will get traded within a Cayman blocker. Any profit will bubble up as ordinary income and get distributed at the end of the year. And then the equities, bonds, and currencies, you receive 60-40 tax treatment on all of these, I believe. So it's 60% long-term, 40% short-term on any realized gains, most of which are going to be rolling on a quarterly basis. So not the most tax efficient strategy. I would certainly urge you to consider asset location. One of the things I will say though is while it's not the most, while that futures yield component is not the most tax efficient, and I would urge you to like Morningstar has a great if you go look at like just trend following strategies, for example, you can look at historical tax drag of different trend strategies to get an idea of what that would do to the return. We do think of this sort of like a cake with icing. Ideally, stacking is adding icing. If the stacking does a job and creates positive returns, taxes are going to wipe some of that icing off, but at least there is some icing left over versus without stacking, you just have the cake without icing. And so, do I like paying taxes? Certainly no. I think just as much as the next person, I try to avoid them wherever possible. But to achieve this stacking, we need to use capital efficient tools like futures, which unfortunately there's no way for us to circumvent any of the taxable nature of them.
Great. Thank you. Can you talk a little bit about just the rebalancing function? And the question specifically came in the context of part of the benefit of lowly correlated strategies, especially relative to equities, is that you can rebalance when the equities are going down and you have other strategies moving the opposite direction. So can you just talk a little bit about rebalancing?
Yeah, so we run the carry signals every single day, coming up with new carry targets. Coming up with new portfolio weight targets. There is a bit of a smoothing process to avoid any what I would call statistical jitter, that can happen day to day. We don't want to just trade noise unnecessarily, but we are rebalancing this portfolio on a daily basis as much as we can back to that dollar for dollar target. And so insofar as these are negatively correlated, we can try to take advantage of any mean reversion that happens between them. We don't presume it will. We just think the real benefit here is adding two lowly correlated strategies into a single ticker. Hopefully, not only enhances the total return, but makes the return profile of that portfolio a lot more attractive.
Excellent. And then a couple other questions here. We received a few that asked, when is the return stacked carry plus managed futures fund coming? So I'll let you speak to your thoughts on philosophy there.
So it's a very attractive strategy. I really do think carry and trend are phenomenal combinations. And when you put them in the same ticker and you can net positions, right, you get a lot of cost savings. Again, the goal for us at Return Stacked ETFs specifically is to offer strategies that provide you with the core beta and alternatives stacked on top. I know we are exploring concepts like core beta plus some sort of more comprehensive systematic macro strategy stacked on top. That may be coming in the future where trend and carry are incorporated there. But really, when you just run trend and carry combined on their own, it really is just ultimately, at the end of the day, a higher volatility systematic macro strategy. And I think it goes back to the same core problems that any standalone diversifier has, which has sort of the behavioral problems and the making room in the portfolio problems that stacking seeks to solve. So maybe our partners at Resolve might consider launching that as a standalone fund, but under the Return Stacked brand, I don't believe we will be looking at launching just trend plus carry.
And on the topic of product launches, can you speak to any thoughts on when RSBY, the bonds and futures yield strategy, might be available?
I don't think I'm legally allowed to speak to that. I guess all I will say is certainly we are looking to bring that to market at the right time. If you are someone who is looking and much more interested in allocating to bonds and futures yield versus stocks and futures yield, please let us know. We're trying to make sure that when we launch, there is sufficient interest in capital that would come into the ETF. So if you think that is something that would be more attractive to you, particularly if that sort of product pays a consistent distribution out, let us know, and that might help accelerate our choice to bring it to market, but hopefully sooner rather than later.
Great. All right. Well, that is all we have for questions today. And so again, Corey, thank you for the explanation. And as Corey stated throughout the conversation, we're just incredibly excited to continue to expand the access to different alternative strategies that are unique from to one another and unique to the existing core stock and bond holdings in most client portfolios. If you have additional questions, you can find us on the website, and the contact information listed here. ReturnStackedETFs.com is where you'll find all the fund information. Additional research and resources can also be found at ReturnStacked.com. And again, thank you everyone for your time, for your interest, and we look forward to connecting with you all soon. Thanks and have a great day.